Dissolution will try to solve the illustration under piecemeal distribution. Now, so we can close the business. For closure of the business, you sell all the asset one after one, not all the assets put together in single shot. We'll sell the assets one by one. The amount realized will be used for settling the liabilities one after one as per the priority. Dissolution piecemeal distribution case. We have capital proportionate method and maximum loss method. So we have two methods here. When it is all about maximum loss method, this is a replication of Garner versus Murray model. Garner versus Murray model. So in case of general dissolution, capital proportionate method is there. And in order to apply the Garner versus Murray method, you have to go for maximum loss method. In the question, they may ask you either prepare using the capital proportionate method or maximum loss method, whatever it may be, you just follow that. Now, assets are sold one after one, and the amount will be first used, probably first realization, second realization, third realization, so on. Part, you will get the money in n number of realization. The first, that amount should be used for payment of usually outside debt, outside loan. After settlement of outside loan, then you can go for settling inside loan, insider's loan. Then after settling this, if you still have any surplus amount, will be used for paying the owner's fund back, capital. If we have 2 or 3 outsiders loan, what we can do? You have to follow the loan ratio. If you have only one outside debt, probably loan 1000. If you get 500 rupees, you can pay 500 currently. Another 500 rupees can be payable later on. But if you have two types of loan, okay, 1000 and another type of loan being 500, probably this loan is received from A, this loan is received from B. If you get 150 rupees by selling one of the assets, how can we pay? This 150 will be payable to these two in their loan ratio. 1000 is to 500, otherwise 2 is to 1 is the ratio. So 100 is given to A, another 50 is given to B. 900 for A and 450 for B. Clear? 900 for A and 450 for B. That's how after the settlement balance is supposed to be payable later on. One more point to be noted here is partner's spouse loan, okay, is also outsider's loan. Is that okay? Partner's spouse loan. Okay. But partner's loan will be insider's loan. A being the partner, Mrs. A, spouse of A. If A gives the loan, is being the partner, no. This is called insider's debt. If the debt is borrowed from Mrs. A, spouse of the partner, then it will be considered as outsider's loan. After paying this, if still you have surplus, then you can pay this one. Understand? So then we'll go for the insider's loan. In case of insider loan, you may borrow from 2 or 3 partners also. In that case, you just follow the loan ratio to settle. And when it's all about capital to be repayable, finally, if still you have surplus, probably we have 3 partners, amount payable to these 3 partners may be 3 lakhs, 2 lakhs and 1 lakh respectively. Like if I have some surplus money now realized, this realized amount will be payable to the 3. How do I make the payment? Settle the outside loan, second inside loan, all these things are over. Finally, make the payment to the owners. While making the payment to the owners, we have 2 methods. Capital proportionate method or maximum loss method. These are the 2 methods. In case of maximum loss method, this method is applicable for usually single partner insolvency case, or you have assumed this is being the single partner insolvency case. So Gardner versus Murray will be applicable. Is that clear? For example, 3:2:1. 3 lakhs, 2 lakhs, 1 lakh is the capital. The partners are sharing profits and losses in the ratio of 1:1. 1:1:1, equal ratio. What does it mean? All the three partners are eligible for sharing the profits and losses equally, 1:1:1 ratio, provided their investment is not replicating their P&L ratio. Isn't it? A has invested 3 lakhs, gets only 1 share. And C has invested just merely 1 lakh, gets 1 share. Invested more and getting lower return by first partner. Now it's a penalizing penalty, like, right? So I invested so huge money and I got just 1/3 share. At least at the time of closure, the excess capital I have invested, now return that me first. That's how he may demand, right? So now what happens? You have to make payment to him 2 lakhs, then it becomes only 1 lakh, and his capital is also 1 lakh. Until their capital is corresponding to their P&L ratio, any excess capital contributed by the partners will be closed to, first of all, is called capital proportionate method. Okay. Now, piecemeal distribution. For distribution of amount received from gradual realization of assets, you are realizing the assets gradually, not in single shot. The following two methods are used. Number 1, highest relative capital method or proportionate capital method. Otherwise, it may be named as absolute surplus capital method. All these things are capital proportionate method in short. In that case, excess capital paid first fully. The partner who has invested more capital compared to their sharing ratio they are eligible for will be paid off first of all. Excess capital will be paid off first of all. After that, their capital ratio and P&L ratios are equal. Thereafter, all the three partners are eligible as per their P&L ratio to get any surplus amount realized. Clear? This is called capital proportionate ratio. The next model is maximum loss method. I will explain that along with the illustration. Let me first finish up the first model. That too, this component, the settlement to the owners alone. Okay. A comprehensive illustration, realization of all the assets in step-by-step model, and we make the payment to outsiders loan, insiders loan, and capital account as a comprehensive one at the last. Right. Let's start with question number 6. This question number 6 I'm going to solve under capital proportionate method as well as maximum loss method, both the methods. Let's start with first method, capital proportionate method. Under this method, you have to prepare working note. How? A, B, C are partners. A, B, C are partners. Sharing profits and losses in the ratio of 5:3:2. Their capital balance and first of ABC balance. ABC as on the date of dissolution, 12,000, 3,000, 5,000 respectively. Assets realized after paying the liabilities. They have paid the liabilities, external liabilities, insiders liabilities paid off. Now we have what? Only the amount payable to the owner's fund. So for that we realized assets in 4 installments. First, second, third and fourth. 4,000, 5,000, 3,000 and 3,000 respectively. Is that okay? They have realized this amount, 4,000, 5,000, 3,000, 3,000. From the given information, prepare a statement of distribution of realizable amount. So you have to calculate this. Okay. Now, I am going to follow capital proportionate method. So, amount payable to A, B, C. Balance. How much they have? At the time of closure, A has 12,000 rupees, B has 3,000 rupees, C has 5,000 rupees. Tell me, who has invested more money for their own eligible sharing ratio? Huh? Who? Is it so? A. I'm not asking about who has invested more capital. I'm asking about who has invested more capital with respect to their profitability. eligible profit. You cannot say what you say this way, okay? But capital per share. A has invested 12,000 rupees for 5 share of profit. It means what's the amount contributed by A per share? 2,400. Isn't it? B, 3,000 invested. What is his share? 3 share. Invested 3,000 rupees and demanded 3 share of profit. It means for every share of profit he demands, he has invested only 1,000 rupees. In case of C, invested 5,000 rupees for how much? How many share? Then per share he has invested. Now tell me who has invested more capital per share. So C naturally. Then who has to be paid first? The person who has invested more for his own sharing profit will be refunded excess amount. Thereafter, all the three will be eligible. Now, how can we find out who has invested to what extent excess? It's very simple. Here, very simple. Take the lowest capital per share as a base and calculate the capital required for all the three partners, keeping that lowest capital per share base. Assume I need to ask A and C also contribute capital as per B's sharing purpose, sharing value. B has invested 1,000 rupees per share for 3 share. 3,000 rupees should be invested. Of course, he has invested only 3,000. But in case of A will say to B, you have invested only 1,000 rupees per share. For me, I am eligible for 5 share, means I need to invest how much? Only 5,000. Per share is 1,000, means for A, for his 5 share, how much he has to invest? 5 into 1,000? 5,000 only. This is called capital required. Capital required of these three partners based on the lower capital, lowest capital. The lowest per capital investment being B, which is 1,000 rupees per share. The same amount will be contributed by other partners also. In that case, A's capital should be 5 into 1,000, 5,000. In case of C, 1,000 into 2, 2,000 will be the capital requirement. Now, from the balance, the capital requirement as per the B's capital base being only 5,000 means what is the excess capital we have in the account of A? 7,000. A has invested 12,000 rupees, but required to maintain only 5,000 rupees. 7,000 excess for A. What about B? He has no excess. He has no excess. What about C? 5,000 minus 2,000, 3,000 excess is there. So before making the payment to A, B and C, all the partners eligible for returning the money, first make the payment to A and C only to the extent of 7,000 and 3,000. First of all, to whom you have to pay? A and C only. Clear? To how much? 10,000. 10,000 will be, if you are having 10,000 rupees, you can pay the entire 10,000 to A and C alone. B is not eligible. After paying this 10,000 rupees, thereafter the capital of A, B, C are being 5,000, 3,000 and 2,000. Thereafter, whatever the payment you do, can do it for all the three partners. Can do it for all the three partners. Is that clear? But in the very first realization, we have only 4,000. We have only 4,000. If we have insufficient cash even to pay for A and C, come on, tell me, to whom this 4,000 will be payable first? If we have 10,000 rupees, naturally you can pay to A and C directly to the extent excess capital contributed by these two. But we have only 4,000, not sufficient enough to pay A and C. Then between A and C, again repeat the same process to calculate who has invested more. Between A and C, who has invested more? Repeat the same. How? Capital per share. A has invested 7,000 rupees for how much a share? 5 share. So, per share he has invested 1,400. B is already not having any excess capital, not applicable. C, 3,000 for 2 share. Then per share, 1,500. Now tell me who has invested lowest share capital. C has invested more. Who has invested lower? A. This amount should be maintained by all the partners. So, you need to find out the capital requirement keeping the lowest capital per share. 1,400 to be maintained by A and C for their own sharing ratio. So 1,400 into 5 share, 7,000. Of course, here not applicable. For C case, 2,800 only required, but he has 3,000 rupees. From this, it is very clear the excess capital invested by C over the other two partner being 200. Other partner being 200. Is that clear? While making the payment, remember, while making the payment, first you have to make the payment to this excess only for whom? C. Up to the 200 rupees, you need to make the payment only to C. By making the payment to C, thereafter A's capital and C's capital becomes equivalent to their P/L ratio. Second, to this extent, you have to make the payment to A and C. This will be only for C. This will be for A and C. First 200 rupees, you have to pay only to the last partner C. After paying the 200 rupees, now A and C will be having the capital equivalent to their P/L ratio. So hereafter any surplus you get will be payable to A and C as per their own P/L ratio, 5:2 ratio. After this payment, 7,000, 2,800 is closed and final payment is this one. While making this payment, all the partners will come. Hereafter all the partners naturally will come. First 200 is only for C. Next 7,000 plus 2,800, 9,800 is for A and C. So first 200 for C. Second 7,000, 2,800, 9,800 is payable for A and C in what ratio? 5:2 ratio. Thereafter, balance, if any, will be payable to all partners in their PSR. Is that clear? Hope you have to finish off this working note. You have to finish off this working note. Clear? Any doubts? Now, let's start this. First realization being 4,000. First realization 4,000 is for whom? For C alone, 200 has gone. Again, we have 3,800. Now finish up paying this 200 first of all to C. From the first realization, make the payment of rupees 200 to C. After this payment, what happens? A's capital being 12 and C's capital being 4,800. Am I right? So for the cross verification, 12,000 and 4,800. 12,000 for 5 share and per share it is 2,400. 4,800 for 2 share, per share 2,400. Once this excess is over, these two partners' capital will be equivalent to their P/L ratio. This one is not required to work out, but to make you understand. Okay. Now we have paid the excess capital to whom? C alone, as is the highest contributor. Thereafter we have 3,200. Okay. The first realization 4,200 is first paid. Balance 3,800 is for whom? This is for C. This is for A and C. This 3,800 will be payable to A and C in their P/L ratio being 5:2. 5:2. Come on, tell me the value. What's the value? 2714 1086. First realization is over. Balance payable being 9,286. 3,000 payable to B. Nothing is paid out of the first realization amount. 3,714 is payable to C. 9,800, 3,800 is paid already. Still we have to pay 6,000 rupees. Further, if you get any more realization, out of that, up to 6,000 is again meant only for A and C. We'll go for the second realization. In the second realization, we get how much? Only 5,000 rupees. We have 6,000 amount to be payable to A and C. So, this entire 5,000 is only for A and C. Thereafter, still we have 1,000 rupees payable only for A and C. This 5,000 should be shared between A and C in their P&L ratio 5:2. Come on, get me the value. 3571, 1429. After that, the balance after second realization. Balance after second realization. How much? 5715. 3,000. Nothing is paid to him. 2,285. Now, we'll go for the third realization. In the third realization, we have 3,000 rupees. In that third realization, still 1,000 is payable only for whom? A and C. Thereafter, balance will be payable to all the partners in their PSR. Okay. This 1,000 is payable to A and C only in their P&L ratio 5:2. 715 for A, 285 for B. C. What about the remaining 2,000, sir? Hereafter, all the three partners are eligible for any distribution. Before this one to be apportioned, find out the balance payable to A, B and C. Come on. 5,715 minus 5,715. 5,000. B remains 3,000. C 2,285 minus 285, 2,000. After this 1,000 rupees payment from the third realization, the balance of the three partners will be equivalent to their P&L ratio of 5:3. Is that okay? Once their capital ratio is equal to their P&L ratio, thereafter all the three partners are eligible. All the partners are eligible. Clear? Now we have the 2,000 will be payable to all the three partners A, B, C in their P&L ratio 5:3:2. If I share this in the ratio of 5:3:2, 1,000 is for A, 600 is for B, and 400 rupees is for C. Now find out the balance. Balance after third realization. How much? 4,000, 2,400, 1,600. Hereafter, any number of realization amount you may get shared among the partners in their own which ratio? In their normal P&L ratio. Balance. After point number 1 and 2, thereafter all the three partners are eligible. Now, fourth realization. Being 3,000 will be shared among the three partners A, B and C. In their P&L ratio 5:3:2, 1,500, 900, 600. Balance being 2,500, 1,500, 1,000. The company will have no more assets to be realized. Then it will be named as deficiency. Deficiency. Clear? Hope now you will be able to understand capital proportionate method. I'm going to solve the same illustration under maximum loss method. Okay. What about the capital base? A, B, and C. Balance capital payable to the three partners and their P&L ratio being 5:3:2. 12,000, 3,000 and 5,000. The assets realized after paying the liability being this one. 4,000, 5,000, 3,000 and 3,000. In 4 realization, they got this money. So I am going to follow which method? Maximum loss method. Maximum loss method. Under maximum loss method, you know, find out the maximum loss after every realization. That maximum loss will be shared to the partners in their P&L ratio. This is called profit or loss of operations. Find the maximum loss to be distributed. Maximum loss. 4, 5, 3, 3. Okay. Come on, tell me. How much is payable to the three partners? Currently, 12, 3, 5. 12,000, 3,000 and 5,000. We assume that the amount you released here in the first case, 4, that is the final amount. We don't get any more amount hereafter. Subtract this amount. Now tell me, the balance amount what we have here is called maximum business loss. If it is being the maximum business loss will be shared by the partners in their PSR ratio. Realization loss like. So after subtracting amount available, whatever the amount payable becomes in deficiency or non-payable, that is called loss. Loss is shared to the partners in their PSR, profit sharing ratio. 12 plus 3 plus 5, 20,000 needed, but only 4,000 is available. We have to pay the 16,000 rupees. 16,000 loss will be shared. How the loss is shared? Using the P&L ratio. P&L ratio being 5:3:2. Come on, tell me. 5:3:2. 8,000, 4,800, 3,200. After that, 4,000 A is to be paid. 12,000 rupees balance is there for A's capital. Last 8,000 rupees is adjusted. Balance 8,000 is payable by the firm to A. In case of B, he has to bring in 1,800 rupees for his shortage. For C, he should be paid by the firm. Is that okay? See here, firm to A, B, C. A has to bring in 4,000 rupees. So A should be paid 4,000 rupees. C should be paid 1,800 rupees. B should bring in 1,800 rupees. Naturally, ultimate value being 4,000. Am I right? This is the amount we have in the first realization. So we already have 4,000 rupees. Ask B to deposit 1,800. If he deposits, we have 5,800. Using the 5,800, you make the payment to A 4,000 and make the payment to C for 1,800. Is that clear? But we assume, now listen, very, very important part. We assume B will not bring the money in the form of cash. When it happens, the loss of B is not brought in by B himself. When it happens, whenever B is insolvent, it will happen. That's why the maximum loss method is similar to Gardner versus Murray. We assume B is insolvent, but not necessarily. We assume any negative balance is there. No, it will not be brought in by the respective partners. Then this loss will be now who has to take care? This loss should be taken by A and C only. In what ratio? Hmm? In what ratio it should be taken? Come on. Hmm? Yeah, make it faster. What ratio? Two losses are there. One is business loss, another one is partner's inability, deficiency loss. The business loss usually you prepare realization account and find that will be shared to the partners their PSR ratio. After posting to the capital, some of the partners is not able to bring the cash in the form of cash, and he becomes insolvent. Then loss will be adjusted in what ratio? Hmm? Capital ratio we have studied in Gordon versus Murray rule. Is that clear? Recap that. As this is the partner's loss, this loss will be adjusted by A and C in what ratio? In capital ratio. This is maximum loss shared in the PSR, and this is partners loss shared using capital ratio. Maximum loss PSR. What is the capital ratio between A and C? 12:5. Capital ratio is equal to 12:5. Now 1800 should be shared between these two in the ratio of 12:5. Come on, tell me. 1270, 530. Now if I subtract this, you will get 2730 dash 1270. Come on. From the balance amount, first you adjusted the maximum loss, business loss. After that, we adjusted the some partners loss also. After adjusting to these losses, still if there is any balance, that balance is payable. So this is the cash payment. Cash payment. Clear? From the balance, you have to adjust the business loss and then partners loss, which is equal to the cash payment. Now, after the first realization, what about the balance? Balance after first realization. Come on, tell me. We have 12,000 rupees, 2,750 cash is paid, balance payable being 9,270. For B, we have not paid anything because he has to bring it. So, entire 3,000 remains as it is. 5,000 minus 1,270, 3,730 will be the balance after first realization. Balance after first realization. Clear? Now you have to repeat the same steps again and again. From the earlier balance, subtract the business loss using the PSR, and then subtract partner's loan using the capital ratio. Repeat this. This will be the cash paid. Now, maximum loss in the second scenario. Maximum loss. Second realization. What is the amount payable? What is the amount payable? 16,000. What is the amount we get in the second realization? 5,000 rupees. Now 11,000 is the maximum loss. Am I right? After the first realization, amount payable to A, B and C, in total it's 16,000 rupees. We have only 5,000 rupees. 11,000 we cannot pay. The amount not payable, 11,000 you know, will be shared or named as maximum business loss, shared by the partners using their PSR. 11,000 will be shared among the three using the PSR being 5:3:2. Come on, tell me. 5,500 for A, 3,300 for B, 2,200 for C. Now subtract the maximum loss, then you will get 3,770 minus 300 negative, and last case 1,530. After the business loss, again we have the loss for B. Is that okay? Now after the maximum loss, find if all the values are positive or not. If all the values are positive, no problem. But here there is a negative value for B. If there is a negative value means he has to bring the cash into the business. But we assume that he will not bring. Okay, if he is not bringing, this loss will be shared by the other partners using their capital ratio. Let's see. Partners loss shared by other partners using capital ratio. 300 removed and the 300 will be shared between A and C using the capital ratio, which is 12:5. I think 21189. Now tell me 3559 dash 1441. After the adjustment of business loss and partners loss, whatever the balance you have now is called cash paid. This is being cash paid. This is being cash paid. Yeah. See what happens then. You have to find out the balance after second realization. Second realization. This is the balance after first realization. From there, cash paid is subtracted. 9,270 minus 3,559. Then this value being 5,711. No cash paid for B, so it remains same, and loss being 2,289. Balance after second realization. Now we'll move on to the third realization. Third, maximum loss in third realization. How much? Now the amount payable to all the three partners being 11,000, but we realized only 3,000. So 8,000 will be the maximum loss, will be shared among the three partners using the PSR. This will be using always PSR. So I'm going to follow the PSR, which is 5:3:2, 5,000, sorry, 4,000, then 2,400, 1,600. After this, if I subtract 1,711, 600 and 689. After subtracting the maximum loss, we don't have any negative balance. If we don't have the negative balance, what does it mean? We don't have any partners loss. We don't have any partners loss. As we don't have any partner loss, this will be the final cash payment, cash pay. Come on, add this cash payment. This cash payment, if you sum, it will be equal to the third realization receipt, 3,000. Cross verify. Now find out the balance after third realization. How much? From the balance, cash paid is subtracted to get this one. 4,000, 2,400, 1,600. Balance after third realization. Then again, maximum loss on fourth realization. How much money we supposed to pay? 8,000. What is the fourth realization amount? 3,000. So the maximum loss being 5,000 will be shared among the three partners using PSR. 5,000 if you share in the ratio of 5:3:2, 2,500 for A, 1,500 for B, 1,000 for C. After that, the balance what you get here is 1,500, 900, 600. No negative. If you don't have negative means there is no partner's loss. This will be final cash payment. So cash paid. This will be cash paid. Now, what is the final value? Deficiency. Deficiency. How do you get the deficiency? From the balance, you subtract the cash paid. Hereafter, we don't have any other realization amount, so this final value will not be recoverable. So this is called deficiency. Clear? We'll now go for a comprehensive illustration, question number 7. What method we have to follow? Higher relative capital method you have to follow. Capital proportionate method. And amount realized given here. For realization. So a comprehensive illustration. A comprehensive illustration. Right. In the liability side, we have creditors and bank loan. These are external liability. While making the payment, you have to finish off external liabilities first. These are partners, and L being partner, he has also given the loan, then it is internal liability, second priority. After making the payment to these three, thereafter only you start make the payment to the owner's fund. While making the payment to the owners, we will either follow capital proportionate method or maximum loss method. But in this illustration, it is clear that highest relative capital method means capital proportionate method will be followed. So capital proportionate method. Clear? So in asset we have cash and bank 2 lakhs and other assets 45 lakhs. Partners share profits and losses equally, PSR being equal. A firm of chartered accountants is retained to realize the assets and distribute cash after discharging the liabilities. Their estimated fees, which are to include all expenses, are fixed at rupees 1,50,000. Okay, chartered accountant is appointed for doing this job. If you are going to be appointed as a person to take this job, what will you do? The company is supposed to be closed, and the company is supposed to face the deficiency. If you are called for doing this job, what will you do? What will you do? Will you get the fees at the last, or will you fix the fees in the very beginning itself? The company is supposed to be dissolved. There is no amount at all. If you keep on working, at the last you don't get anything. Immediately management say the company is dissolved. You have to take the decision. So you don't get anything. So the management, the person who is taking care of this will estimate and keep the money set aside. It will not be distributed. But this amount is freezed and kept aside in a bureau or locked in bank account. Will be used for final payment, but the final payment is only 1 lakh. So estimated fees is kept aside. While finishing the work, now the chartered accountant demands his fees, and that fees is taken from the amount kept aside. 1.5 lakhs is kept aside, so from there 1 lakh is taken, another 50 released will be payable to the partners only. Will be payable to the partners only. Is that clear? This is the logic. In the very first realization, 5,50,000 realized, which is inclusive of cash and balance, cash and bank, some portion of assets. All other assets realized this way. First, second realization 15 lakhs, third realization 15 lakhs, thereafter 30 lakhs, finally 29 lakhs 50,000 rupees. What you have to do? What you have to do? Initially, keep 1.5 lakhs for fee. You can use only 4 lakhs. And this one. Finally, you know the fees is taken up by chartered accountant being 1 lakh. So another 50,000 is free refunded to him. Clear? From the very first realization, the amount is kept aside for future fees. On finalizing the fees, from that amount kept aside, subtracted balance is remitted. Sir, what happens if it is 2 lakhs, sir? Already 1.5 lakhs is there, shortage 50,000 will be taken from the last realization. Let me first finish off repayment of these three. Thereafter, I can go with capital. Okay, creditors, bank loan, and then else loan. First priority goes to creditors and bank loan because external liability. Then you have to make the payment to partners loan, which is internal liability. What is the balance we have? 2 lakhs, 5 lakhs, 10 lakhs. Is that okay? Now, first realization. How much we have? 4 lakhs. This 4 lakhs can be used for paying creditors and bank loan. Both will be equally ranking. As both are equally ranking, amount payable to these two being 2 plus 5, 7 lakhs, but we don't have 7 lakhs, we have only 4 lakhs. Now this 4 lakhs will be shared between these two in their loan ratio 2:5. Which ratio? Loan ratio 2:5. Come on. Share this 4 lakhs. Finish up this 4 lakhs first of all. I'm going to use this one first of all. Make it faster. 1,14,000. I round off to the nearest thousands and 2,86,000. Rounded off to the nearest thousand. Okay, nearest thousands. After the first realization, balance payable to the outsider as well as insider's debt. Balance after first realization. How much? 86,000. 2,14,000. Yes, loan remains unpaid. Second realization. In second realization, we get 15 lakhs. We have the sufficient money to pay the creditors, bank loan, else loan and all. 86,000 paid. 2,14,000 also paid. 10 lakhs also paid. Almost 13 lakhs used. After that, still we have 2 lakhs rupees. This will be used for paying whom? To the owners. While making the payment to the owners, the calculation is pretty different. Either capital proportionate method or maximum loss method will be followed. So now balance 0. Clear? Come on. Finish up copying this, then we'll go for the settlement of capital from here. Finished? Text me. Now, for settlement to the partners, I need only this detail. I'll start with this detail here. Okay, I want only this detail, right? Yes. After that, we have balance amount in second realization being 2 lakhs. Third realization being 15 lakhs. Okay, 2 lakhs, 15 lakhs, 30 lakhs, again 30 lakhs. Okay, 29.5. With that, this excess amount can be used. Now, LMS. LMS are the partners. Their P&L ratio being equal, 1:1:1. Capital balance payable to them. All the liabilities paid except the capital. So now I am going to finish up payment of the capital using capital proportionate method. Capital proportionate method. In case of capital proportionate method, you have to prepare what? Working note. You have to prepare the working note. C. L, M, S. What is the capital invested by LMS? 15 lakhs, 10 lakhs, 5 lakhs. Their P&L ratio being 1:1:1. Find out capital required per share. Capital required invested per share by L being 15 lakhs, M being 15 lakhs at 10 lakhs, S being 5 lakhs. Among the three, the lowest contributor is who? Who is the lowest contributor? S is the lowest contributor. Now you have to find out the capital, keeping the lowest capital base. As S has contributed only 5 lakhs for his one share, whereas L has contributed 15 lakhs for the same one share. Excess by 10 lakhs. Directly you can understand. So, as this logic, as per the S capital contributed, LMS should also have only 5 lakhs in their own value. Balance will be called excess. 15 minus 5, 10 lakhs. 10 minus 5, 5 lakhs. No excess. So before you make the payment to S, L, M should pay first of all to the extent of 10 and 5. If the question rises between L, M and who is L, M, who is paid first, then again repeat the same steps. Okay, capital per share. 10 lakhs for one share, 5 lakhs for one share. Between these two, who is the lowest contributor? M. Capital based on the lowest capital. 5 lakhs is the lowest capital. For one share, L should have only 5 lakhs and M should also have only 1 lakh. Right. Not applicable here. Now find out the excess capital. Here 10 minus 5, 5 lakhs is the excess. No excess here, no excess here. While making the payment, first you have to pay this one for L. Up to 5 lakhs, you have to make the payment only to L. Next, up to 5 plus 5, 10 lakhs, payable to L and M in their PSR ratio. Balance thereafter will be payable to all the partners in their PSR. This will be completely for L. This is only for L and M in the ratio of 1:1. Last one is for all the partners. Clear? Now, In the second realization, still we have how much excess? 2 lakhs. So, second realization. Second realization. We have 2 lakhs, up to 5 lakhs, we have to make the payment to L only. Now, I finish up paying 2 lakhs here. Over, only for L. So, balance after second realization. L to be payable 13 lakhs, M 10 lakhs, and S 5 lakhs. Now we'll go for the third realization. In the third realization, we get how much? 15 lakhs. In that 15 lakhs, from 5 2 is subtracted 3 lakhs, we have to pay only for whom? L, no. So 3 lakhs is payable only to L. After paying this 3 lakhs to L, the balance payable to L being only 10 lakhs. So then L and M will have their capital ratio and P&L ratio being same. Thereafter, another 10 lakhs will be for L and M. Yes, we still have. This will be for L and M. This is for L, this is L and M. L and M will share this equally, 5 lakhs for L and 5 lakhs for M. Come on. Cross verify what is the balance we have after this. For L, 13 lakhs minus 8 lakhs, 5 lakhs. M, 10 lakhs minus 5 lakhs, 5 lakhs. Yes, 5 lakhs only. Now their P&L ratio as well as capital ratio being same. Hereafter, whatever the excess amount you have, will be shared among all the partners equally. 2 lakhs will be shared among all the partners. 66,667, 66,667, and 66,666. That's all. The sum becomes very easier now. The sum becomes very easier. Balance after third realization. 4,33,333, 4,33,333, 4,33,334. Hope you'll be now able to understand. Third realization is over. Now, fourth realization. What is the amount? 30 lakhs. Hereafter, whatever the money you get will be shared among all the partners equally. 10 lakhs, 10 lakhs, 10 lakhs. Now, come on, tell me. What's the value for L? What's the value for L? Make it faster. Yes, make it faster. 5,66,667. What is this? Surplus paid already. Surprisingly, here we have the surplus. Balance payable to the three partners being only 4 lakhs something. But we pay 10 lakhs means there is a realization gain. Realization gain. For him also. For him also. Okay. Surplus. Now, last fifth realization. Also 30 lakhs will be shared among the three partners equally. 10 lakhs, 10 lakhs, 10 lakhs. Yes, Come on, tell me the value. What is the final surplus? Make it faster. What is the final surplus? Hey, use the calculator. Make it faster. What is the final surplus? That's why I asked you. That's wrong. What is the surplus? Tell me, what is the surplus here? 15,66,667 is the surplus. Already there is a surplus. Again, I am distributing further. Then your surplus will. You have to add. Double cautious. That's why I asked you. I know you where you will make mistake. 15,66,666. See, in all these cases, company has to pay. So each and every payment later, the balance gradually decreases. But in this case, it is not amount payable. Already he got more than what he has invested. Surplus is there. You are happy that you get more than your investment by 5 lakhs something. Further, I am giving another 10 lakhs. Now tell me what is your surplus? Already 5 lakhs plus another 10 lakhs. So 15 lakhs plus your surplus. Don't say after subtracting, that's wrong. You have to be careful here. Clear? This is the only twist most of the students confused in this illustration. Okay. If it is clear, text me. So we will move on to the next question. Now, we'll go for the question number 8. In this question, we are going to use maximum possible loss procedure. The assets realized in full in the order in which they are realized. They are listed. So first realization you get 1000, second realization you get 2000, third realization you get 1200, fourth realization you get 4000 rupees. Each and every asset listed in the asset side realized in the same order like statement is given and the same values also. B is insolvent. If any one of the partners is insolvent, then definitely Gardner versus Murray will be applicable. Gardner versus Murray means automatically it's a maximum loss method. Maximum loss method. If the question is clearly stated, then no problem. If it is not so, we have to be double cautious. And ABC are partners sharing profits or losses in the ratio of 5:3:2, and their capitals are this one respectively after paying creditors. Creditors paid. Creditors already paid. Is that okay? Now, I'll solve this separately here. Yes, tell me. So, spouse of partners and partners loan is there, liability of loans. Spouse of partners loan is external, partners loan is internal. First priority is this one, second priority is this one. Thereafter, capital will be repayable in the third lot. While making the payment, we follow here what method? Maximum loss method. Maximum loss method is followed. A, B, C. We'll start with spouse loan. We have to pay that one, right? Spouse loan. then partners loan, then capital A, B, C. The P&L ratio being 5:3:2. Okay. Capital 9,600, 6,000, sorry, 2,000. Spouse loan is 2,000. Partners loan 1,000. Capital being this one 9,600, 6,000, 8,400. Okay. So I want only the amount realized. PSR is here. Now, in the first realization, we get amount realized by selling the investment. So, realization number 1. We get 1,000. Should be payable to whom first of all? This ranks first, second, and here we follow maximum loss method. Maximum loss method. This 1,000 is first used to pay the spouse loan. After this, the balance payable being 1,000, 1,000, and 9,600, 6,000, and 8,400. After first realization, balance after first realization. In second realization, we get 2,000 rupees. As you realize 2,000 rupees, first you have to pay to whom? Come on. Spouse loan. We paid completely. Still we have surplus another 1,000. Can be used for whom? To pay whom? Partners loan 1,000. So this is also closed. Dash dash here 9,600, 6,000, 8,400. Balance after second realization. Balance after second realization. In case of third realization, as we follow the maximum loss method, you have to find out the maximum loss. Maximum loss in third realization. How much is payable to the 3 partners? 24,000, am I right? How much money we got in third realization? 1,200. 22,800 we have the balance payable to the 3 partners using the PSR ratio. Follow the PSR. Yeah. 22,800 will be shared among the 3 partners. Huh? 9,400. 9,400. 11,400. Okay, 11,400. Then 6,840. 4,560. Now you get the balance. 1,800 negative. This is partners loss. Partners loss. Here 840 gain. And here 3,840 payable. And partners loss will be adjusted using which ratio? Capital ratio. So this 1,800, I think this is also negative, right? 840 negative, sorry. We get 2 negative value. Then these two negative value will be adjustable only in the partner's capital where it is sufficiently having money. So 1800 is reversed, 840 reversed, 2640 subtracted here. 0, 0, 1200. After adjusting these two losses, what are the left over? That is called cash pay. Cash pay. Clear? You got the cash paid here. Cross check. You have the amount here in the third realization. Now this third realization 1200 is payable only to see after the calculation of two items. What is that? What are they? Cash paid is equal to opening balance minus business loss using PSR and minus partners loss using capital ratio. This is the order. Now balance after third realization. Balance after third realization. 9,600 nothing paid, the entire 9,600 remains balance. 6,000 remains as it is. 8,400 minus 1,200, 7,200 will be the balance after third realization. Balance after third realization. Now, last realization. Realization fourth. Maximum loss in fourth realization. What is the amount payable to them? 22,800. In fourth realization, we got 4,000 rupees. 18,800 will be the maximum loss will be shared among the three partners using PSR ratio. Hope you will be getting 9,400 for A, 5,640 for B, 3,760 for C. After this, you get 200, 360, 3,440. 200, 360, 3,440. We don't have any negative. We don't have the partner's loss. As we don't have the partner's loss, just to subtract the business loss from the opening balance to be considered as cash paid. So this is cash paid. Now, hereafter we don't have any other assets to be recoverable. From the whatever the balance they have, cash paid is subtracted. Balance will not be recoverable at all. Will be named as deficiency. Okay, deficiency. Okay. 9,600 minus 200, 9,400, 5,600, 3,760, non-payable at all. Non-payable at all. In the earlier class illustration, payment is more than the worth. But here, non-payment. Here, non-payment. Is that clear? So this one is 5,640. Okay. Accounting of Limited Liability Partnership, LLP. This act came effective from 1/4/2009. LLP is a body corporate. Like company, they can also enjoy the limited liability. That's the advantage here. Formed and incorporated an LLP Act, not Partnership Act. LLP has common property of partnership and company. It's a blend of these two. Company enjoys the limited liability, partnership enjoys some other benefits. These two benefits are available in LLP, and this is limited liability. Minimum number of partners 2, designated partner being 2. Minimum designate partner. At least one of them shall be resident in India. Designated means the person who is taking care of the administration, working partner like Dave. Individual or body corporate may also be partner here. In partnership firm, individual can be partners or sometimes half may also be partners. Similarly here, individual and body corporate can be partner. It has a separate legal entity. After the name, LLP is attached. Like company, after the name of the company, company limited added. No, similarly here LLP is added. Okay. Alteration of partners will affect the existence of LLP. In case of means company, share capital may be easily transferable from one hand to another hand. The company will not get affected, but here it's not so. Alteration of partners will affect the LLP. All the things are similar to partnership only. As per rule number 24, class 1, sub rule number 1, you have to maintain the books of accounts, financial position, and all these things. What are the books of accounts you need to maintain? Receipts and payment, record of assets and liabilities, goods purchased, stock, work in progress, finished goods, cost of goods sold. Any other particulars if the partner is willing to show or maintain the books of account, they have to maintain for minimum 8 years. Minimum 8 years they have to maintain. Statement of account and solvency, you need to report. Because the liability is limited, you know whether the LLP has solvency capacity or not. If the loan being 10,000 rupees, their asset being 50,000 rupees, no problem. Suddenly the asset value decreases to 5,000 only, then there's a trouble to repay even the loan, right? So they have to intimate their solvency proposition good or not. That's a mandatory requirement for LLP, not required for the partnership firm. Prepare a statement of account and insolvency within 6 months from the end of the financial year. Statement of account and insolvency statement. Solvency statement. This is signed by designated partner. Statement of account solvency filed in form number 8 with the registrar. Company registrar you have no. Similarly, as per the company registrar, this LLP should also be filed to the company registrar only within 30 days from the end of 6 months from the financial year. And this is available for public inspection also. Public inspection means my company record, Singar Academy's record, you cannot come and see and cannot ask. But in case of LLP, if Singar Academy being LLP, I have to intimate what is my assets position, what about my liability and other things will be available in the registrar's office ROC. Then you can download and verify whether my business is good or not. You can verify. Public inspection is anybody can come and see our account. Okay, this is usually for the company. As it is being the LLP having the flavor of a company, this one also be available for public inspection. Public inspection. Now, the partnership form, in case of LLP, balance sheet. Given in rule number 24, part B of LLP, in form number B it is given. Form number B. Is that okay? See, we'll name this being statement of assets and liabilities. The balance sheet is named this way. In the liability side, what we have? Contributions and liabilities. We cannot say equity and liability because it's not equity capital, only capital contribution. Number 1 being partners fund. Partners fund. Under that, contribution, like equity share capital, here we have the contribution, reserves and surplus. Second being liabilities. Under the liabilities, you can list down the secured loan, unsecured loan, short term, creditors, other liabilities. And then you may have the provisions. Taxation, provision for contingencies, insurance provision, other provisions if any. This is a list. In broader sense, partners fund, liabilities, provision. 3 items will be there. In partners fund, capital contributed, reserves and surplus. In case of liability, you start with secured and then unsecured, then short term, creditors and other liabilities can be posted here. When it's all about assets, we have to start with the gross fixed assets. From there, accumulated depreciation subtracted. So, asset, investment, loans and advances. Then current assets and current liabilities, current assets will come. Current assets, inventory, debtors, cash and cash equivalents, and other assets you need to disclose. This is the format. If you have any contingent liability, it should be shown below the balance sheet, right? So here it is stated separately in this case. This is the format. So in case of balance sheet, what happens here? We'll start with contribution and liabilities. And in contribution, partners fund. Partners fund. What we have under partners fund? His contribution. Another one is resource and surplus. Second one being liabilities. Third one being provisions. In case of assets, you have to start with a gross fixed asset minus accumulated depreciation. You will get net fixed asset. Thereafter, you need to write investment and any loans and advances given. Apart from that, normal current assets, what do you have? Debtors, stock, cash. Apart from these things, if you have any other things, then you will mention it separately. Like expenses paid in advance and probably amount recoverable, income accrued, all these things are shown here. This is the format you have to follow. But in case of income statement, it is again different. Also vertical format. All the credit items are shown here very first of all. And all the debit items also be shown here. Okay. Here, you start with the gross turnover. If you pay any excise duty or service tax, that should be removed from the gross turnover, so net turnover can be identified. And you need to give the breakup of net turnover. How? How much is domestic turnover? How much is export turnover? Domestic turnover and export turnover. What will you do? You may be the trader buying and selling of the goods. You may be the manufacturer. In that case, you sale of goods manufactured. You may be the service provider, then supply of service. All the three. I may be the service provider, or I may be after all trader buying and selling. Otherwise, I can manufacture and sell. Whatever the nature may be, I have to show all these revenues clearly here. Domestic as well as international. Is that okay? Finally, what do you do in trading account? Opening stock, purchases, closing stock. That's how you show and sales. Isn't it? Opening stock 1000, sales being 10,000, closing stock being 2000. How do you show in this form? Sales 10,000 rupees, changes in stock 1000 becomes 2000 rupees. If the closing stock is increasing, what happens to the profit? Profit increases, right? So it should be addable. The difference is addable in vertical format. If the closing stock is lesser, you have to subtract. See here, plus or minus, either increase or decrease in stock. What sort of stock? Raw material, work in progress, and finished goods. In case of expenses, raw material, purchases, power and fuel, all these expenses. Then from that, you can subtract the tax and profit transfer to the partner's account. That's the order. That's the order you have to follow. Okay. All the debit items are shown in this block. Credit items are here. In that credit item, the format is slightly different. Slightly different. Right. Let's try to solve this one. One illustration. Before that, let me finish off the penalty applicable here. Penalty on non-maintenance of the books of account. For LLP, 25,000 may be extended up to 5 lakhs also if you are not maintaining the books properly. And every designated partner also, the working partner like you have here, named as designated partner, he should also pay the fee or penalty. 10,000 may go up to 5 lakh, sorry, 1 lakh. Annual return. So you have to file an annual return duly authenticated with the registrar within 60 days on the closure of the financial year. If it is not so, then the final fee or penalty will be payable is similar to this one. And this annual return filed, that statement, income statement or a balance sheet you show, any public can come and see this. This is called public inspection. If you are not allowing this for public inspection, or if you are stating wrongly to the public for inspection, there will be chances of imprisonment for 2 years and the liability for paying the fine is anywhere between 1 lakhs to 5 lakhs. And not only that, your books of accounts should also be audited. So what are the things are there in LLP? You have to maintain the books of accounts, yes, penalty will be leviable. You have to file this to the registrar, or penalty will be leviable. Not only that, it should be available for public inspection. While public inspection not available or misstated, then again penalty and imprisonment also be applicable. And you need to get your books of accounts audited. Appoint CA and get it audited. No other way to escape. Clear? Now let's try to solve this illustration. Come on, join with me to solve this illustration. Make it faster. Okay. P and Q, the partners of limited liability partnership, Messrs. P and Q, LLP, dealing in electrical goods. The following is the trial balance. Come on, inventory. Inventory will be changed. This is asset, premises asset, bank asset, sundry debtors asset, sundry creditors liabilities, secured loan liabilities, unsecured loan liabilities, return outward. Okay, purchase return will be adjusted with purchases itself. Okay. Outstanding expenses, liabilities, sales revenue from goods traded, sales revenue from services rendered also given, and indirect tax on turnover subtracting from the sales. Indirect turnover should always be removed from sales transaction value. Interest received on investment, other revenue. Interest received, other revenue. Okay. Purchases, salaries, rent, stationery, communication charges, insurance, advertisement, delivery charges, interest on debt. All these things are normally expenses debited to the P&L account, but here second half we are going to post. Second half. Furniture, fixtures, assets, long-term investment, investment asset, cash asset, and general reserve, owners' contributions and partners' fund, P's contribution capital, and Q's capital contribution also capital. Yes. Now, come on, prepare along with me. Yes, tell me. Statement of income and expenditure. Statement of income and expenditure. And statement of assets and liabilities. Statement of assets and liabilities. I'll start with this information. I'll pick up to this item, unsecured loan. I'll finish up the inventories last. Okay, otherwise I may post here. I think this may be revenue list first column, expenses column, expenses for the second column, and contribution here, asset here, so that I can post easily. In income side, changes in inventory will be posted, changes in stock. Okay. If the closing stock is higher, then it's a gain addable. Otherwise, closing minus opening. The opening value here being 4.5 lakhs. I don't know what is the closing value. Currently, I keep it pending. Equipment. Now I'm going to post all the assets. Come on, open along with me. Come on, make it faster. Equipment. 5 lakhs 50,000. 5 lakhs 50,000. Do we have any adjustments here? Unsold inventory closing, we have 5 lakhs 62,500. I will finish up that first of all. 5 lakhs 62,500. So closing stock. Inventory. 5 lakhs 62,500. The difference between opening and closing. Closing is higher. If the closing is higher, then what happens? It's a gain. How much is that? 450 becomes 5 lakh 62,500. 1 lakh 12,500 increases. 1 lakh 12,500. Clear? Outstanding rent amounts to rupees 36,000. In your liabilities, you start with partners fund. First, second being liabilities, third being provisions, third being provisions. So outstanding rent, then I'll post that value here. Rent, outstanding rent to rupees 36,000 should be addable. Another posting, it should be a liabilities, right? Outstanding rent, double entry. Okay, normal balance sheet, but the pattern is different. Rest will be normal final accounts like. Rate of depreciation on furniture fixtures 10%. In case of furniture fixtures, these are assets. Furniture fixtures minus depreciation 10%. I'll keep it pending. Depreciate equipment 67,500. So equipment and depreciation on the equipment here being 67,500, and here depreciation for equipment 67,500. For furniture fixtures, we have to find out and post it later. Provisions to be created 22,500 for possible bad debts and 1,80,000 for taxation. So, provision for taxation. Provision for taxation. Okay. Provision for taxation. From earnings before tax or profit before tax, you have to find out the provision which is 1,80,000 rupees. And this will appear in provisions, provision for taxation, 1,80,000. And you have to create the provisions 22,500 for bad debt. So provision for doubtful debts, PDD 22,500. Again, it will be subtracted from where? Debtors. Debtors minus PDD 22,500. Is that okay? So I have completed posting the adjustments twice. Hereafter I will pick from here up to the asset. I will finish off. Here already I have posted what? Inventory is completed. Rest. Equipment being 5,50,000. From there 67,500 is subtracted to find out the closing balance of asset. 4,82,500. Depreciation is already calculated. Premises 8 lakhs. and bank will come after debtors value being 9 lakhs 46,500. Sundry debtors 3 lakhs 60. PD 22,500 subtracted, then the value being 3 lakhs 37,500. I have posted all this value. See, though it is vertical, how do you study? In case of trading and P&L account, this is debit, this is credit. But here, this one is debit, this is credit like. And this will be your liabilities, this is asset. Resembles like the same. But you are writing one by one. This is called traditional, this is called modern T format. Okay. Why do we have the T format rather than why do we have the vertical format rather than T format? Okay. We adjusted ourselves for the printer. Earlier manually writing, so they will have the big book. How many of you seen the big notebook? So once when I was in college as a lecturer, old students' record was supposed to be taken. Then department head asked me to go and see the office room to track the old students' record. Then I went to the office room. They asked me to wait for 1 or 2 hours, and thereafter they took me to the register office. The note, almost 3 feet length, half of your height. I asked him, how do you write? Will you lie on this to write this? Yes, sir, sometimes it's so. For one student, the entire record is maintained. You see that in the case of Excel sheet, how many columns you can open? For a student, name, email ID, address, and the phone number, and all the particulars can be written in one line itself. It's now available in Excel sheet. Earlier, it was manually written in the note. But now what happens? No, okay, we'll write so lengthy one, no problem, but we don't have the printer. Printer is usually for A4 size. A4 size printer, 10,000 rupees. I want a big printer to record A3 or A2 or A1. No problem, sir. This is 10,000, that is 1 lakh. Do you want to get the bigger one for 1 lakh? No. So I can manage preparing everything for A4. So this format is now converted into A4. That's why the vertical format becomes very popular. Right. Hope you'll be now able to understand. Don't get confused with this vertical format. It's very simple. Normal, what you learn, no debit and credit here, not debit and credit, only income and expenses. That's all. Next, 3 liabilities are there. And I'll pick these 5 items to be posted. Come on. Sundry creditors will fall here. 1,65,000. Secured loan will be the first one. 1,80,000. Unsecured loan is the second one. 1,35,000. Returns outward. Purchase return will be subtracted from purchases. So purchases minus purchase return. Value being 67,500. Outstanding expenses, a liability. So I have to post here outstanding rent and outstanding expenses 24,000. All these items are over. Then we have 2 more revenues. Tell me, sales revenue. Here income. Under the income, start with what? Sales from goods, 53 lakhs, and services, 2,35,000. Overall amount you recovered being 55,35,000. Clear? And what about this one? Excise duty, indirect tax on turnover should be subtracted. Indirect taxation. I name this being IDT. How much is that? 1,35,000. So net revenue being 54 lakhs. See, if you go to the shop and purchase an item for rupees 100, immediately seller demands 18% GST. How much you have to pay? 118 rupees you are paying. Now, what is the revenue to the seller? For the purchased item, you paid 100 plus GST 18, 118. What is the revenue for the seller? Is it 118 or 100? Huh? It is only 100. The 18 rupees collected is to deposit with the government. It's not his income. He has to deposit with the government. He has to retain only 100 rupees. So 100 rupees is the income. So any revenue collected 118 from that GST collected is subtracted. Net will be only 100 is income. The GST collected is deposited to the government. It's the amount payable to the government. Is that clear? And interest received on investment, other income. Other income. Okay. In other income, you have interest on investment. This value being 67,500. Hope now you'll be able to understand this one. Apart from that, now we have a set of expenses. There is no doubt you can directly post that in the expenses side. We'll start with purchases 29 lakhs 47,500. Written 67,500 subtracted. So finally 28 lakhs 80,000 rupees. Salaries one after one. From this I am going to post here. Salaries 8 lakhs 45,000. Rent and rates already I showed here. So from that 312. Outstanding 36 is added. Then 3 lakhs 48,000. Stationery charges, the value being 13,200. Communication charges, the value being 27,300. Finish up copying this. Huh? Don't listen me. Just don't listen me. You just join with me to answer. Seems to be you are being the master and being the student testing me. Huh? Sir, you are right, sir. Sir, you are wrong. Like, huh? You have to work along with me. Come on. Insurance 54,800. Advertisement 44,200. Delivery charges 48,000. Interest on debt 95,500. I have posted all the expenses. Apart from that, we have these items. Furniture and fixtures. Asset 5 lakhs 40,000. But 10% depreciation 54 will be created. So 54,000 depreciation of furniture fixtures. After subtracting 54, what is the value you are having? 4 lakhs 82,500. And long-term investment asset, long-term investment 3 lakhs 15,000. Cash, bank and cash 2 lakhs 10,000. General reserve in partners fund, you have peace contribution 13 lakhs, and then general reserve 2 lakhs 70. 2 lakhs 70. I picked from here. And Q's contribution 9,50,000. 9,50,000. Make the error corrected. 9,50,000. Add 10 in the question. Q's contribution 9,50,000. Hmm? 4,80,000. Okay. 4,86,000. Now, find out the total income. 54 lakhs, 67,500 and 1,12,500. Total income being 55 lakhs, 80,000 rupees. From this, you subtract the entire list from here to here. I think this entire value being 45 lakhs, this entire list, 45 lakhs. Total expenses. From the total expenses, from the total income, subtract the total expenses to get the profit before tax. Profit before tax being 10,80,000 rupees. Provision for taxation 180 is subtracted. Balance 9 lakhs profit transferable to the balance sheet. Transferred to balance sheet. Reserves and surplus. So here already 2,70,000 you have, another 9 lakhs is going to be addable here. This is previous year balance, this is current year value. Find out the total of the contribution and liabilities. I think this is 41,40,000 rupees. Similarly, total the asset side. Hope we will be getting 41,40,000. It is now agreed. So the income statement as well as assets and liabilities statement will not have any complications. Normal final accounts, but prepared in vertical format. The main points to be noted here is about the closing stock, opening stock difference. Another one is indirect taxation should be subtracted from the revenue. Rest will be the normal final accounts like. Okay.